Have you used Uber recently? Grabbed a ride, maybe
Yeah.
ordered some food, sent a package perhaps?
Chances are, yeah. Most people probably have.
Well, today we're doing a deep dive into Uber's Q2 2025 earnings report.
Hmm.
We've gone through their latest financials, the investor calls, news clips.
Oh, the good stuff.
Exactly.
Yeah.
We want to unpack what really drove their performance, what it might mean for their future, and maybe even, the broader economy.
Mm-hmm.
So get ready, because honestly, there's a lot of impressive growth here.
Mm-hmm.
But there are also some, let's say, complexities hiding just under the surface. It's kind of fascinating.
It really is. And what's fascinating here is that these earnings reports, they aren't just dry numbers on a page, right?
Right.
They're more like a vital strategic snapshot. They give you a pretty comprehensive look at a company's health, its efficiency, its strategic direction.
Especially for a company like Uber that's everywhere.
Exactly. It tells you a lot, not just about Uber itself, but about, well, wider consumer behavior and market trends too.
Absolutely. Okay, so let's dive into the big picture first. Those headline numbers. Uber certainly delivered on the top line.
They did.
Revenue for Q2 2025 hit $12.65 billion. That's an 18% increase year over year. And interestingly, it actually beat what the market was expecting, which was around $12.47 billion.
A solid beat then.
Yeah. And on top of that, gross bookings, that's a key indicator, right, for demand across rides and delivery.
Crucial metric, yeah.
That reached $46.76 billion. So up 17% year over year.
And I think it was even slightly better in constant currency.
Right, up 18% in constant currency. Yeah. So, adjusting for those foreign exchange swings gives you a cleaner look at the actual business growth underneath.
Right, removes the currency noise and that robust demand. You can see it reflected in just the sheer volume of activity on their platform, too.
Billions of trips, right?
Yeah, an astounding 3.27 billion trips taken. That's also up 18% year over year.
God.
And their monthly active platform consumers, MAPCs, they call them, grew to 180 million. That's up 15%.
It's a lot more people using the platform regularly.
Precisely. And these aren't just one-off users. These are people consistently engaging. It indicates a widening, probably quite loyal user base. That's often a critical engine for future growth, even before you see it fully in the revenue.
Makes sense.
So what you're seeing is across the board, all these key metrics, revenue, bookings, trips, active consumers, they're all growing pretty consistently around that 18% mark.
Yeah, it really points to broad-based demand, doesn't it, for both rideshare and delivery?
Definitely. Seems like both core segments are firing.
Okay, so that's the top line. It's undeniably strong. But let's dig into profitability and cash flow, because I think this is where the story gets really compelling for Uber.
Mm-hmm. The bottom line matters.
Hugely. Income from operations dramatically increased. Came in at $1.45 billion. That's a massive 82% jump year over year.
82%. That's huge.
It really is. And their adjusted EBITDA, that key measure of operational profit, kind of stripping out the non-cash stuff.
Right. Things like depreciation.
That reached $2.12 billion. So up 35% year over year. And it now represents 4.5% of gross bookings.
Which is an improvement, right? I think it was 3.9% before.
Yeah, up from 3.9%. So progress there.
And that improvement, that jump from 3.9% to 4.5% of gross bookings and adjusted EBITDA, it's not just a number. It really suggests Uber is getting, significantly more efficient at turning all that revenue into actual operational profit.
Better cost control, maybe? Or pricing power?
Could be a mix of both. It's definitely a critical sign of maturity for a tech platform like this. But here's what's, I think, particularly noteworthy. Their cash generation.
Ah, yes, the cash flow.
Operating cash flow hit $2.56 billion. That's up a huge 41% year over year.
41%.
And free cash flow, what's left after capital expenditures, came in at $2.48 billion, up 44% year over year.
Really strong numbers.
Very strong. And their trailing 12-month free cash flow, looking back over the whole year, actually hit a new high of $8.5 billion.
Okay, that rolling 12-month figure gives a better sense of stability, right? Smooths out the bumps.
Exactly. It gives you a more stable, kind of long-term view of their ability to generate cash, smoothing out any quarterly ups and downs. It's a really strong sign of sustainable financial health.
And this is the kind of cash that fuels, everything else. Reinvestment, returns.
Precisely. It fuels reinvestment back into growth, and it fuels shareholder returns.
And speaking of shareholder returns, they also announced a new, frankly, substantial $20 billion share repurchase authorization.
$20 billion. That's a serious number.
It is. And for you, the listener, a share buyback like this, it isn't just A simple vote of confidence, though it is that too.
It's a strategic move.
Right. It's a way to return capital to shareholders. It often signals that management thinks the stock might be undervalued, or maybe just they have really strong free cash flow that's more than they need for immediate internal projects.
It can be a powerful signal of financial strength. Plus, reducing the share count typically helps boost earnings per share, EPS.
Which investors definitely like to see. Okay, so we've got all this overwhelmingly positive news, right? Record numbers, massive cash flow, this huge buyback.
Seems like a slam dunk.
Exactly. So it's quite a paradox, isn't it?
Yeah.
Despite all these strengths, Uber's shares actually slipped, what, 1–2% in after hours, trading right after the report.
Yeah, a bit of a head scratcher on the surface.
So what's the market seeing here? Or are investors just weighing other factors more heavily? What gives?
Well, this brings us to that crucial question, why the sort of muted reaction, or even slightly negative reaction?
Yeah.
The immediate concerns seem to stem from a couple of areas. One is definitely the high-cost investments Uber is pouring into the autonomous vehicle space, robotaxis.
Right. That takes serious cash up front.
Huge capital outlays. And the market is also still kind of wrestling with overall valuation worries for the company, maybe feeling that the current price already baked in a lot of that good news we just talked about.
Okay. The old price to perfection concern. And there was also some softness in their freight segment, wasn't there? That often flies under the radar a bit.
It does. It's a smaller piece, but yeah, revenues there were basically flat, maybe even down about 1%.
Okay.
Which does point to some specific challenges in that market, probably linked to, broader headwinds in the logistics sector overall.
So a factor, even if it's not the main driver.
The contributing factor, yeah. And that kind of leads us to what we might call the ugly side, maybe. The significant uncertainty still surrounding autonomy.
Ah, yes, the robotaxis again.
Investors are definitely scrutinizing Uber's, $300 million investment in Lucid?
Yeah.
And their partnerships with Waymo and Nuro?
Big names, big bets.
Absolutely. And the key question here isn't really if robotaxis are coming anymore. That seems, increasingly inevitable.
Right. It feels like when, not if.
Exactly.
Yeah.
The question is when they'll become truly profitable, and maybe even if they can scale efficiently enough to actually justify this massive investment.
Yeah, the unit economics have to work eventually.
They have to. And any setbacks in this area, which is highly capital-intensive, technologically super complex, could certainly weigh heavily on investor sentiment, especially given the sums involved.
Okay, so autonomy is a big cloud of uncertainty, financially speaking.
For now, yes. And it's not just autonomy. There's also this ongoing sort of valuation and margin pressure. We mentioned the adjusted EBITDA margin improving to 4.5%.
Yeah, which is good, but...
But it's still under 5% of gross bookings, and this creates a really delicate balancing act for Uber.
How so?
Well, how do they keep reinvesting aggressively in these crucial but expensive growth areas like autonomous vehicles or expanding into new markets without sacrificing that margin expansion?
Right. Investors want to see those margins keep climbing. It shows maturity.
Exactly. Margin expansion is critical because it signals Uber is maturing from just a pure growth story into a company focused on sustainable profitability. That's a key shift investors look for in, established tech giants.
And if they misstep on that balance...
Missteps there could definitely increase share price volatility for them. It's a tightrope walk.
Okay. So connecting all these dots then.
Yeah.
The bottom line seems pretty clear, right? Uber delivered what you'd probably call a clean beat.
On both top and bottom lines, yeah.
They showed record cash flows, announced that really substantial $20 billion buyback, all of which underscores, immense confidence in their core platform.
Yeah.
That's rideshare and delivery.
The core looks very healthy, however. For you, the listener, you've got to understand that the near-term share performance might stay a bit... choppy is probably a good word.
Because of those big future bets and pressures.
Exactly,
Yeah.
because of those significant capital outlays for autonomy, those persistent headwinds we mentioned in the freight segment, and just the ongoing challenge of balancing growth with those margin dynamics.
So it's a situation where you've got strong fundamentals right now.
Yeah, meeting elevated execution risks and valuation risks down the road. It creates a more complex picture than just the headline numbers might suggest at first glance.
It really is fascinating, isn't it? Seeing a company with such robust present performance also grappling with these huge kind of uncertain future bets.
Definitely.
We've explored how Uber delivered this blend of strong financial results, but also these strategic challenges in Q2 2025. and how digging a bit deeper reveals so much more than just the headlines.
It's like finding that tiny, almost invisible inclusion in a diamond, isn't it? That's where the real story often lies.
Yeah, well put.
And that leads us to maybe a final provocative thought for you, the listener, to consider. Given Uber's really bold bets on autonomous vehicles and this continuous pressure they face to expand margins, how might the company's long-term identity actually evolve?
Good question.
Will it stay primarily a logistics and mobility platform as we know it, or will its future be increasingly defined by these technological ventures?
Like becoming more of a tech R&D company that also runs a network.
Potentially. And what does this constant balancing act between nailing current profitability and investing heavily in future innovation? What does that mean for any company trying to scale in these rapidly changing markets?
Something to definitely mull over.
Indeed. Until our next deep dive.